What if you could invest in the next big thing? Think Apple in 2007 or Tesla in 2015, before it takes off. Growth investing is about catching those waves of innovation that reshape the world and your wealth. Ready to ride the future? What is growth investing? Growth investing is like betting on the fastest horses in a race. Companies with explosive potential to outpace the market. These are businesses, often in tech, biotech, or renewable energy, growing revenue or earnings at 15 to 20% annually, far above average. You're not buying cheap. You're paying a premium for innovation and future dominance. Take Emma, a 27-year-old graphic designer with $3,000 to invest. She's drawn to companies like NVIDIA, which surged 2,000% from 2015 to 2020 on AI and gaming growth. Growth investing suits her. She's young, can handle risk, and loves the idea of backing visionaries. Unlike value investing, it's less about current bargains and more about future giant. Why does it work? Data shows growth stocks, tracked by indices like the Russell 1000 Growth, averaged 14.6% annual returns from 2000 to 2020, outpacing broader markets. These companies reinvest profits into expansion, not dividends, fueling rapid gains. But it's volatile. Crashes hit hard, like Tech's 2022 dip. Emma starts with a brokerage like Fidelity, using its screener to find stocks with revenue growth above 20%. She's not chasing stability. She's chasing potential. Emotionally, it's thrilling, like backing a startup you believe will change lives. Practically, growth investing demands a long-term view despite short-term swings. Emma learns to stomach 20 to 30% drops, knowing winners recover. It's about conviction in innovation's trajectory. Identifying high-growth companies. Spotting growth stocks is like scouting talent. You look for signs of breakout success. Key metrics. Revenue growth 20% plus annually, high return on invested capital, ROIC above 15%, and expanding market share. These signal a company's ability to scale. For example, Raj, a 34-year-old engineer, screens for tech firms on Finviz with earnings growth over 25%. He finds a cloud computing company with 30% quarterly revenue jump. Digging into its 10Q report, he sees rising customer adoption. Think Zoom during 2020's remote work boom. Qualitatively, look for disruption. Does the company solve a big problem like renewable energy or AI? Check X posts for buzz. Real-time sentiment often flags rising stars. Raj follows industry news, noting competitors' struggles, which strengthens his pick's edge. Risks exist. High price-to-earnings (PE) ratios, often 50+, mean you're betting on future profit. In 2021, some growth stocks like Peloton crashed when growth slowed. Raj cross-checks with analyst reports on Seeking Alpha to avoid hype traps, ensuring his pick has a clear path to dominance. Evaluating market trends and innovation. Growth investing thrives on riding macro trends. Think AI, green energy, or telehealth. Understanding these waves is critical. For instance, a 2023 McKinsey report predicted AI could add $13 trillion to global GDP by 2030, boosting firms in that space. Consider Aisha, a 30-year-old teacher investing $1,500. She spots the electric vehicle (EV) trend, with global sales up 60% in 2022. She researches a battery tech firm with patents for faster charging cells. Its stock's PE is high, but EV adoption data from BloombergNEF supports her bet. Look for megatrends via sources like X, where analysts share real-time insight. Aisha sees posts hyping EV infrastructure. Her company's tied to it. She also checks management. Is the CEO a visionary like Elon Musk? Earnings calls reveal strategic clarity. Don't ignore risks, trends fade. .com busts in 2000 burned growth investors. Aisha diversifies across two sectors, EV and AI, to hedge. This blend of data and foresight fuels smart bet. Balancing risk in growth investing. Growth stocks are roller coasters, high highs, steep lows. Managing risk is non-negotiable. First, limit position size. No stock should exceed 5 to 10% of your portfolio. A 2022 tech crash showed single stock bets can wipe out gains. For example, Liam, a 29-year-old freelancer, allocates $4,000 across 5 growth stocks. When one biotech tanks 40% on failed trials, his portfolio dips only 8%. He uses stop-loss orders at 15% below purchase price to cap losses, balancing risk with opportunity. Volatility demands emotional discipline. Growth stocks often swing 20% monthly. Liam tracks via apps like TradingView, ignoring daily noise. Historical data. Growth indices like Nasdaq 100 recovered post-crashes, rewarding patience. Diversify by sector and stage. Mix early-stage startups with established growers like Adobe. Liam uses ETFs like QQQ for broad exposure, softening individual stock blows. This approach keeps him in the game without panic. When to buy and hold. Timing growth stocks isn't about market dips but about entry points tied to catalysts, product launches, earnings beats, or sector tailwinds. Buy when momentum builds, like after a strong earnings report. Sell when growth slows or valuations hit absurd levels, like PE ratios above 100. Take Sophia, a 33-year-old nurse. She buys a cybersecurity stock post a major data breach headline, expecting demand to spike. It jumps 25% in 6 months. She holds, but sets a price target at 50% gain, based on analyst projections from MarketBeat. Data supports holding. A 2021 Fidelity study showed growth stocks held 5+ years averaged 15% annual returns. Sophia uses alerts to track news, competitor losses, or regulatory shift. If fundamentals weaken, like slowing user growth, she exits. Avoid FOMO buys. Chasing a stock up 100% risks buying at the peak. In 2020, some bought Zoom at its high, then saw 30% drop. Sophia waits for pullbacks or confirmation of sustained growth, keeping her moves calculated. Building a growth portfolio. A growth portfolio is like a tech startup team, diverse, dynamic, high potential. Aim for 8 to 15 stocks across sectors like tech, healthcare, and consumer discretionary. ETFs like ERKK add instant diversification with curated growth pick. For instance, Noah, a 26-year-old barista, invests $2,000, splitting 60% into individual stocks, e.g., a gene editing firm, a fintech disruptor, and 40% into growth ETF. This balances risk. ETFs smooth volatility while stocks offer upside. Rebalance yearly to lock in gains. If one stock balloons to 20% of Noah's portfolio, he trims it, buying underperformers with strong fundamentals. Morningstar data shows rebalanced growth portfolios outperform static ones by 1 to 2% annually. Noah uses robo-advisors like Wealthfront for automation, tweaking risk levels. This setup feels empowering, backing innovation while protecting his downside. Avoiding common growth investing mistakes. Growth investing's allure can blind you to pitfalls. First, avoid chasing hype. Meme stocks like GameStop in 2021 burned latecomers. Always check fundamentals. Is revenue growth sustainable? Don't overpay. Sky-high PE ratios signal bubbles. Think .com stocks in 1999. Compare to industry averages. A 2022 Goldman Sachs report flagged stocks with PE above 80 as high risk. Ignoring diversification is deadly. One bad stock can tank an undiversified portfolio. In 2022, concentrated tech investors lost 30% plus when rates rose. Spread bets wisely. Finally, don't panic sell on dip. Growth stocks drop hard but recover if fundamentals hold. A disciplined checklist, growth rate, moat, market trend, keeps you steady. Monitoring and adjusting your growth strategy. Stay vigilant but not obsessive. Check quarterly. Are your companies still growing 20% plus? Use tools like Yahoo Finance for updates. If a stock story changes, say losing market share, reassess. Adjust for macro shift. Rising interest rates, like in 2022, hit growth stocks hard. Shift to resilient sectors like healthcare. X posts can flag sentiment shifts. Monitor for early warnings. For example, Mia, a 31-year-old consultant, tracks her portfolio with Morningstar. When her AI stock's growth slows, she pivots to a renewable energy play gaining traction. A 2023 JP Morgan study showed adaptive growth investors outperformed static ones by 3%. Set alerts for earnings or news. Stay informed, not reactive. Discipline drives long-term wins. Growth investing is your ticket to backing the future's biggest winners. Companies reshaping the world through innovation. We've covered spotting high-growth stocks, riding trends, managing risks, and building a portfolio that balances thrill with smart. Start small, research one stock today, and ride the wave of progress to wealth. Action is everything. Don't wait for the perfect moment. Check the description or pinned comment for free tools and exclusive tips to jumpstart your growth investing journey. Since you've made it this far, YouTube's lined up the perfect next video for you. It's on screen now, so keep riding that wave.